Today, we're looking at one of the most talked about names in real estate tech, Opendoor Technologies, ticker symbol OPEN. Once hailed as the future of home buying, Opendoor is now in survival mode. The U.S. housing market is struggling, interest rates are high, and the stock has developed a reputation for wild, meme-like price swings. The big question is, can Opendoor reinvent itself and make a comeback? Or is it heading for a slow fade into irrelevance? Let's find out. What the company does. Opendoor's core business is called iBuying. They purchase homes directly from owners, make necessary repairs, and resell them for a profit. It's a bold idea, but it requires huge amounts of capital. And when the housing market slows, the risks skyrocket. Now Opendoor is evolving. The company is moving to a hybrid model. Sellers can still get a fast, all-cash offer from Opendoor, or they can choose a traditional listing with a real estate agent in Opendoor's network. In the second quarter of 2025, revenue came in at $1.57 billion, up 4% from last year. Net loss was $29 million, an improvement from last year's loss of $92 million. But trouble lies ahead. Q3 revenue is expected to fall sharply, landing between $800 and $875 million, at least 36% lower than the same period last year. Other recent moves. Opendoor canceled a planned reverse stock split after regaining Nasdaq compliance, raised $325 million in convertible debt to refinance older obligations and strengthen the balance sheet, and launched aggressive cost-cutting to preserve cash. The strategy going forward. Opendoor knows that pure iBuying is too risky. It locks up too much money and leaves them holding too many unsold homes. By partnering with agents, the company gives sellers more options and reduces its own exposure. In the short term, the mission is simple: survive. Cut expenses, conserve cash, and wait for better market conditions. In the long term, the goal is clear: reach profitability and scale when the housing market recovers. Management believes that could happen in late 2026 or later. The outlook. Short term, the picture is challenging. The housing market is still weak. Mortgage rates remain high. Revenue is sliding. And the share price is often driven more by social media hype than by actual fundamentals. Long term, there's potential. The hybrid model could improve margins and make the business more resilient. But success will depend on falling interest rates, a stronger housing market, and strong execution. The risks are high. The company could burn around $150 million a year in cash, and its debt load adds extra pressure. Investor view. This is one of the riskiest stocks in the market today. It's not profitable. It's facing powerful economic headwinds, and it's burning cash. The stock surged more than 245% in July, but it's still down 10% from last year and down a staggering 97% from its all-time high. If you're a conservative, risk-averse investor, this stock is one to avoid. If you're a speculative trader who understands the risks, you might consider a very small position, but only with money you're fully prepared to lose. Opendoor is in the middle of a complete transformation. Working with agents is a smart move, but the benefits will take years to show. And ultimately, the company's fate will depend on housing market conditions that are beyond its control. If you want stability and predictable returns, stay away. If you're chasing high risk with the chance of high reward, a small, speculative bet could make sense. This is an all-or-nothing story. Either Opendoor survives and thrives, or it burns out. That's the full breakdown of Opendoor Technologies. Do you see this as a comeback story, or a stock to avoid? Let me know in the comments. And if you found this analysis helpful, hit like and subscribe for more deep dive stock breakdowns. Thanks for watching.